Hi there, welcome back to another round of videos in our course Research on Corporate Transparency. Well, this is Unit 4, and we will deal with capital markets in this unit. We also talked about capital markets in the prior units, we touched on them, but now they are, let's say, the center of our investigation. And we will start with a very important notion when it comes to information and capital markets, and that's market efficiency. So market efficiency is a term that I trust most of you have heard in your studies before, and I also believe that many of you will be familiar with the work of Eugene Farmer that was very influential on this. And here is the definition that he used in his seminal Journal of Finance paper in 1970. So here he defined market efficiency as a market in which prices always fully reflect available information, and such a market is called efficient. Okay, so as people that study information, obviously this is an exciting definition for us because it means that there is a condition under which we can assume that markets actually subsume all relevant information for asset prices. And that would be awesome. Yeah? So if markets would be providing this property, then for us as, let's say, people that worry about the distribution of information in the economy, that would be, market would be super, right? So that would be, the truth revealing machine, basically. And markets are extremely powerful when it comes to information discovery. Many of you will be familiar with the work by August Hayek. So maybe, I'm not sure about this, but Hayek is a very prominent economist, Nobel laureate. And he has understood markets as means for price discovery, right? So, and information discovery. So this is really a central property of markets, that markets can discover information and that markets can use this information to make prices more informative. So, and if to anybody who's interested in transparency, even if you're not a free market advocate, I think it's absolutely crucial that you understand how markets work and how markets discover information. To me, the whole field is more or less the question of, well, how efficient are markets in this? Can we trust them to do their job well? Under which conditions do they fail? Under which conditions do they actually perform really well? Because if we think about regulation, we always have to think about regulation conditional on the market environment that is already out there. And we have to think about these complex interchanges when it comes to regulation and information production on markets. So stuff that we also discussed in the last unit. So I think this is why it is really crucial that we think about information as something that markets can, let's say, discover. Okay, so perfect. So now we have a definition at hand. And let's say if markets would be fully efficient in a farmer sense, then I think our topic would be much easier. Okay, so now let's try to understand under which conditions this is actually being fulfilled, and this is actually what basically this whole unit is about, if you want. Okay, good. So first thing, what are sufficient conditions for market efficiency? So this is more or less directly building off the original Farmer paper. Maybe a little bit over summarized, but I think here for our purposes will do very nicely. So, if you have a market on which there are no trading or other transaction costs, on which information is in principle available to all investors at no cost. So, there are no search costs, and all investors are rational and have homogeneous beliefs. Then on such a market, all information should be priced, should be reflected in asset prices, and such a market will be informationally efficient. These are sufficient conditions, but not necessarily necessary conditions. So this is important, right? So that means under these conditions, Marv will tell us that normally, that the market should reflect all information, but obviously there could be other conditions under which the market also will reflect all available information. So this is why these conditions are called sufficient. So I trust that you are familiar with the terminology, necessary and sufficient conditions. If you are not, then there is some sweet spot in your background in terms of math. So, and I would strongly encourage you to work on this because in the end, math is the foundation of a lot of stuff that us scientists do, right? So, well, good. Okay. So now when you see this and you reflect on this, you will instantly think, sorry, this is not going to be fulfilled in real life, right? So we know that transaction costs exists. We know that information acquisition is costly. Yeah. So we are accountants in the end, right? So we know how hard it is to understand the notes of the financial statements. We know that students have to study and sometimes even suffer for that. So I think there is ample empirical evidence that these assumptions are not fulfilled. So information is costly, trading costs are there, sometimes they can be substantial if liquidity is low, and we also know that not every investor is rational all of the time. And we also know that they don't share homogeneous beliefs on how to understand the information that is out there. So clearly, very clearly, these assumptions are violated. Okay? So now, when you understood the whole theory debate that we had in the last units, then you now have two ideas here. So the first idea is, well, is this violation so severe that the underlying mechanism of the market no longer holds? So you will be tempted to study whether some information costs are still okay. Yeah. So this is what the next element of this unit is basically about when we talk about Grossman-Stiglitz 1980. Okay. So this is one way to think about it. So to say, okay, I get it. Assumptions are violated. So let's see whether under somewhat more lenient assumptions, whether the basic mechanism of market efficiency still goes through. Yeah, that's one very reasonable question. Yeah, so the other very reasonable question that you can ask yourself is now, given that these assumptions are violated for maybe some investors, does it matter, if there's still a group of, investors that is very close to this at hand? Yeah, so whether there are still some let's say marginal investor that actually has this property. So maybe this is then still working out okay. So you don't need every single investor to be rational. Maybe it's just sufficient that the investors that actually trade are rational. And you also think about this, well, how can I develop models that factor these effects more closely? So now when you think about this a little bit more, this is the underlying motivation for a lot of the market microstructure literature in finance. Yeah, so, and we will be touching on this very mildly during this unit. And I think this is an exciting area if you're really striving to understand the informational properties of markets in detail. Okay, good. So now we take this and then we take it one little baby step further and we think about, well, how can we formalize this market efficiency definition a little bit more to have a more reflective discussion on how it actually works and what are the the important drivers here. And here what I do is I try to be very abstract here in a way. I try to formalize this in a way that is also close to Farmer 1970, and I just reflect on two sides here. The left side is unobservable, yeah, and the right side is what we can observe here. So on the left side, you see first of all available information that is out there, identified by a capital Y. Okay, so and capital Y sub t minus 1 means the information that is out there at a given point in time in the past. Yeah, so this information, we cannot observe this information, unfortunately, right? So, but there is information that is being used by market participants. And this information, in principle, we could observe. Yeah, so in principle, meaning we would have to have let's say, an instrument in which we could actually collect that information. For example, we could survey each and every single market participant, and assuming that the market participant would truthfully reveal, this would be very hard to do empirically, but if the market participants would reveal this, in principle, we can observe YM, right? So the information that is actually being used. So now, this information amount here, this information amount that is, let's say, the true information amount that is available to all the potential market participants, this information amount will result in a true set of prices. So now this is now a little bit artificial, this argument, but think about the following. In principle, there is a price that correctly reflects all information out there for every single asset that has been traded. And since we are inherently in the multi-asset environment, what we get is not a single price, we get a distribution of prices. Okay, so in principle there is something like this. Yeah, so the correct manifestation of each price that results from all the available information that is out there. So this is the true distribution of prices. That does not mean that each individual would have the same willingness to pay under the circumstances, but with a market, all these willingness to pay will sort of work out, and then in the end you would have prices that clear the market. Okay, so this is the idea of this true distribution of prices. So now what we can relatively easily observe, at least in public equity markets, would be the distribution of market prices that we actually observe. And this is then a function of the information that has been used by market participants. Whereas the true distribution of prices in T would be a function of the available information. So now, what is basically the definition of market efficiency is that these two should equate each other, right? So they should be equal. If they are equal, then the market will reflect all information impounded into price. Okay, so this is the idea of the market efficiency, let's say, definition. So now, the problem with all this is it's impossible to test empirically without additional assumptions. So obviously, when you look at this equation down there, you see the right-hand side. Yeah, so you can observe the right-hand side. The left-hand side is where it becomes complicated, right? So the left-hand side requires you to have an assumption about how prices actually should be built on available information. That's tough. So you need an asset pricing model. Yeah, so you need an asset pricing model, and asset pricing models are, of course, there are many, yeah, but at the same time, they are all, mostly off, right, to some extent. So meaning that whatever you do, you can run tests, but each and every test will be a joint test of the market efficiency hypothesis and the asset pricing model that you apply. Okay? So if the test fails, and normally it will fail, depending on how you test it, but it will fail eventually, so then you don't exactly know whether you just shown that you violated the market efficiency assumption, or you violated your market model. Because the market could still be using all available information, so it could still be informationally efficient. You're just a little bit off with the way that you assume this F function looks, like the asset pricing function looks. Okay, so you can never be sure about this. And this is basically the underlying problem behind all this nice notion of market efficiency, that market efficiency in itself is not testable. Yeah, so we can strive to understand markets better. We can come up with better or more convincing, let me put it that way, asset pricing models. And that way, maybe we are able to understand better how markets process information, but we will never be able to actually establish that markets are informationally efficient, or whether they are informationally efficient. Tough luck, right? So this is important to me because this also speaks a little bit towards whether it is a wise idea to simply assume that markets are informationally efficient. So this is tempting to assume that markets are informationally efficient, because if they would be informationally efficient, that would have also, let's say, put it that way, very good implications for asset pricing. Okay, so here I list some of these implications if we assume that markets are informationally efficient. So the first thing is obvious. So this is almost the definition. All available information would be impounded into price. So that would be good. So markets would be very efficient pricing mechanisms, right? And that also would mean that prices only react to new information because all the stale information has already been impounded. And new information we normally assume to arrive randomly. Well, it's almost the definition of information that arrives randomly, because otherwise, if we could predict information, then it would be stale, right? It would already be there, right? So information in itself is something new, and this new we cannot predict, and as we cannot predict the new, it has to be random. So meaning that if all this is true, then we can believe security prices to follow a random walk process. And actually, this is not a bad prediction. So we see that security prices are pretty random in behavior. So it's really hard to predict them. So to predict them well, right? And that means, there is some point to it. So that it's, that markets are not that dumb. Yeah. So if you ask me what is the most convincing piece of easy evidence that markets are somewhat informationally efficient, I'd say look at how hard it is to beat the market, right? So if they wouldn't be informationally efficient or very bad in incorporating information, then it should be relatively easy to beat the market. And it's not that easy. Okay, good. So this is an application, this random walk process. That also means that investment in this, would be more or less a fair game, conditional on the information set that is out there. So you can invest, but the expected abnormal return from informed trading is zero. Simply because you cannot benefit from your information because the information is already impounded into price. So meaning that you can expect to earn, whatever the return of the market is. So there's some risk adjusted return, although I'm being relatively silent about what this exactly is. But so there is no abnormal return. There is no such thing as a free lunch, right? So this means this is a very strong prediction. Yeah. So and also something that is relatively true to what we observe empirically. So it's hard to make money on the capital market in excess of the normal returns that you simply receive for your risk. Okay. So now the next thing is, you could also expect that investors are actually price protected on such a market, meaning that since the price reflects all available information, you can invest into stocks without having all the information processed yourself and still assume that you will earn the risk-adjusted, in expectation, the risk-adjusted return of your portfolio. Okay, so this is super. So now, when you are a little bit familiar with, let's say, the history of financial economics, then you think, yes, these are exactly the predictions that brought us the financial crisis 2007, 2008. So this is a little bit political now, but when you read this, you think, okay, this is more or less gives you an indication of, no fear. The capital market is wonderful. He processes all information. So simply just, invest and be done with it, basically. Yeah. So pick your risk preference. Based on your risk preference, pick your risk loadings and then just invest into this wonderful market, and the market will do the rest for you. Yeah, it doesn't really work out perfectly in recent years. So, yeah, there is some, as I said, there is some truth to all these. There is some empirical validity to all these statements, but there is also some cases where we see that the market failed miserably. Yeah, so. The way that the market, for example, produced information on housing prices in the beginning of the housing price bubble in 2007 was clearly not informationally efficient. So the market was really late to the game. Yeah, so there are these cases where the market does not work well. And I think one key thing to understanding this well is to reflect that these are not, let's say, predictions that are rooted on very strong empirical beliefs and clear evidence. These are more or less predictions that come from a model or from an understanding of how markets work that is untestable. Yeah, and the core assumptions of this model are very clear to be off. Yeah, still markets are good in discovering information. And still, some of these implications here have empirical support, but we shouldn't believe in them as saying, okay, now this is established, so this is how markets work. No, they work like this some of the time, or maybe most of the time, but clearly not all of the time. And this is why it's dangerous to apply these corollaries of the market efficiency hypothesis as predictive of reality, and even more so to use them for blunt security investment advice, right? So this would be really dangerous. So now we see what the market efficiency debate has brought to us. So first of all, it really focuses our discussion of capital markets on information. And I, as an accountant, I love this because I really think that this is super important to focus on the information role of markets, right? So this is perfect. B, it has shown us some, or provides some explanations why markets are extremely hard to beat. And C, it also shows us how hard it is to actually, let's say, establish that markets are informationally efficient. Most likely we can never do it. by design. And that means it's worthwhile to study this a little bit more and worthwhile to understand maybe the conditions under which markets are informationally efficient and also the conditions under which markets are not that informationally efficient, okay? So very interesting stuff. Now, Farmer has established 3 different forms of market efficiency, and I want to just talk about them very briefly because sometimes this terminology will be used in later units, and also it's very, very much established in the literature. So I think it is important that you are familiar with this. So obviously, this notion that all available information should be impounded into price is a very strong assumption or a very strong prediction, and Farmer has developed 3 different types of information sets, basically, and on which you can make a statement about market efficiency. So now that is there is no longer one market efficiency, but there are 3 different types of market efficiency. So the first one is what we call the weak form of market efficiency, and that basically only requires that all market prices observable up to the point where I actually make my forecasts or predict prices are impounded. Are impounded in market prices, right? So the market prices contain all available market price information. So if this would be true, if the weak form would be true, there would be no point in the typical, technical analysis, chart analysis that people sometimes like to do, right? So draw lines and see, this is a support line or whatever. Stock prices should go further on because of this. All these kind of voodoo would then be more or less pointless. And there is good empirical evidence that on average it is pointless. So the weak form of market efficiency has a relatively robust, if you want, financial empirical support. It's also good because it is more clearly testable because we can at least observe this information set very well. So now, when it comes to the semi-strong form, so that reflects all publicly available information. In principle, that would also be observable because it's publicly available, but you see that this information set is already extremely rich. So because there is a lot of information available, right? So, and it's not only, especially if you think about information broadly, and you should think about information broadly, it's not just, let's say, the financial disclosures of a firm or the press releases of a firm and the prices. It's also all the other macroeconomic news that there is and all the big data that floats around and the chat on Reddit. So it's basically everything, right? So now putting this into a model becomes inherently complicated. And this means the semi-strong form is hard to test, not only because we don't know the market model well, but also because, this y sub t minus 1 is really hard to actually measure. So that would be the semi-strong form. And this is the semi-strong form is interesting for accounting because it basically would mean that, all accounting information is reflected in price. Yeah? So because accounting, financial reporting is by definition publicly observable. So meaning that, the semi-strong form would say, okay, there is no need or no use in the interpretation of historical financial reporting data. Yeah? And we have pretty convincing evidence that analysts still do that, right? So they go back in time and look at old financial statements from time to time. Yeah. So to show that, to verify that, let me say their understanding of the economy is still correct given new information, right? So there seems to be some use of this. So semi-strong, there is already relatively convincing evidence that there are violations to this. Then and strong is, let's say, the form that is also being used in the original definition, all available information, yeah, even the private information. And here we see also relatively convincing evidence from insider trading rules and so on that the strong form of market efficiency is violated. So it's not that all private information is being priced in markets. Yeah. So, but these 3 types are also helpful to discuss, let's say, violations of market efficiency. So you can say, okay, is the violation such that it would even violate market efficiency in semi-strong form, or does it only apply to the strong form of market efficiency? This is why I believe personally that these 3 different levels are very helpful to inform the debate. Okay, good. So this was, let's say, the financial economy part of this element. Now we move on to a classic. Yeah, so I labeled it here the accounting classic. the paper by Ball and Brown, which is published in Journal of Accounting Research 1968. This is a paper that many people believe single-handedly, more or less, started entirely new field of accounting research, empirical capital market research in accounting. Yeah, so there are others. There are also very similar work by Bill Beaver on the debt market. So I don't want to say that this is the one and only paper, far from it. But I think it's really, really an influential paper, and I think also for us as researchers 50 years later, or almost 60 years later, so this still is a very interesting study to pick up and read, and also to reflect upon. So what does this study do? Real quickly. So this study tries to understand whether accounting information actually informs asset prices. And what they do back then, they look at a sample of listed firms, so 261 firms, very relatively small sample. But these were different days, right? So first of all, data processing was much more complicated back then, yeah. So and B, also the information environment was much poorer for many firms, so it was useful to focus on firms that actually have all this information available. Okay, so what they look at is earnings per share, earnings announcement dates, and share returns, so relatively straightforward. The overall motivating question is, well, does the market react to these earnings per share announcements? Yeah, do you see that they inform the market, that they are reflected in price? Yeah, relatively easy, straightforward question to ask. So for that, you have to measure the surprise in earnings, because sometimes you have EPS, but they are exactly like expected by the market, so you won't see much price reaction. And sometimes earnings are really a surprise, right? A surprise to the market. And if they are a surprise to the market, then you should actually see whether the market reflects or reacts or not. So for that, Ball and Brown come up with different ways on how to measure these unexpected earnings, the earnings surprise. Basically, they use comparisons to prior year EPS values, right? And then based on the sign of this surprise, they allocate firms to two portfolios, so whether they are good news or bad news firms, right? So they will have the positive surprise and negative surprise portfolios. Then they measure market reactions, and by that they calculate monthly abnormal returns. They use some market model again, and they build on the capital asset pricing model, and use different variants. So this doesn't really matter too much, but calculate the abnormal return based on the expected or a beta type return, right? And then they sum up these monthly abnormal returns to some cumulative measure, and for both portfolios. Okay, so this is what they do, relatively straightforward, and this is what they find. So this is an original clipping from their paper, and here you see our two different portfolios and the total sample, and then you see different variables for each portfolio, so meaning different measures of A, earnings surprise, and B, also capital market returns. And what you see in this picture, I think, can tell you a lot about accounting and capital markets. And this is why I believe even 50 years later, 60 years later, it is still very, very influential. Yeah. So you see that there's clearly a price differentiation between the good news and bad news firms. Yeah. So for the good news firms, you see that prices over the fiscal year increase, and for the bad news firms, the prices decrease over the fiscal year. Okay, so this is comforting, because it tells us, first of all, that accounting and capital market prices are somewhat in sync. Yeah, so firms that do well in terms of accounting always also tend to do well on the capital market on average, right? So this is comforting, because otherwise we would say, oh, well, there would be completely conflicting signals. And given that we believe that capital markets are relatively good at picking up information, it would be a little bit, well, a little bit bad for accounting if accounting would show signals that completely orthogonal to the capital market. Okay, so that's the first thing that you see. The second thing that you see is that the market leads earnings. And to understand this is you have to look at this vertical line around zero, because this is the point in time where the annual report is actually being announced. Okay, so And you see that most of the price movement actually is prior to the earnings announcement, in the months prior to the earnings announcement. So the market is good in picking up information that is not already reflected in accounting, but has been materialized through other channels during the fiscal year. So think about a well-performing firm that has success on the market. Obviously, there are signals about this also within the fiscal year. For example, maybe you have industry reports on let's say units. You see people driving around in the street, maybe with the new car from the manufacturer or something like this. So there is information out there, even in the 50s and 60s, that help the market to assess the let's say the financial situation of the firm absent the financial accounting. Yeah, and earlier, more timelier. So prices lead earnings. This is a very important takeaway, because sometimes you have, even in the political debate, you have this impression that accounting advocates, that they believe that what they produce as signals is something that is entirely new to the market, and that it's all about informing the market about the financial situation of firms. And then you say, yeah, the market is not that dumb, right? So sometimes the market gets it way earlier than the accounting. And this is to some extent also hardwired into the accounting rules, because the accounting rules obviously require verification, and this delays the process. So this is the first and most important thing that you see here, besides that there is this association. So then, and this is a little bit harder to grab from the picture maybe, but I think you still see it. There is a relatively pronounced short window return of the news itself. So the capital market reacts to earnings or prices. So this has been then later developed into an earnings response coefficient literature. So the earnings response coefficient tries to understand the market reaction in a narrow window, currently like 3 days in most studies, around the actual announcement, and you see that earnings or prices are being priced. Yeah, so this is still the case. So there is new information in earnings, so that the market has not understood before. Yeah, so the market was unable to predict. And that's, of course, also comforting for preparers of accounting information, because it seems that they produce something that is genuinely new to the market. By the way, those of you guys that are taking the course with us and also obtain credits, there will be an assignment where you actually calculate earnings response coefficients. So for nowadays data in the US, so that you get a feel about what this means. Okay. So now you also see that after the months after the actual announcement, there is some drift. And this drift means that even after the news is there, the stock still moves into the direction of the news. This is called post-earnings announcement drift, and has also been studied extensively in accounting. And this is always, many times, it's been considered as a pricing anomaly, because normally, markets should reflect, these old information. And in this case, it's even old price information. So you see the price effect of the short window announcement. And then this price effect seems to predict the future returns for weeks a little bit. Yeah. So now this is a violation of the weak form of information of market efficiency. Yeah, because you could predict this even simply from the stock price itself. And this is called an anomaly, a stock pricing anomaly. And there is a very extensive debate about whether this is an indicator of some risk. So in other words, whether the market model is misspecified. Again, think about the joint test problem. So whether the market model is misspecified, or whether this is actually a clear violation of market efficiency, right? So all these insights from one study. And this one study is from 1968. Impressive, right? And for those of you, so two things, and then I close this unit, this element, sorry. Two quick remarks about this. So the first is, I will put this into the comments on YouTube. There is a very nice little YouTube piece on, I think it was the 40-year anniversary of the Ball and Brown study. They celebrated it in Sydney. So nice video. I will put it there so you can see some sort of interviews with Ray Ball, with Brown. Really nice. And the other thing is, to all of you that are currently thinking about doing something entirely new and fresh in your PhDs, to take a bold move, to think about accounting differently, to use different data, different methods. So Ball and Brown was genuinely new and innovative when they did it in the 60s. And it was not that the paper was loved instantly. So it was rejected by the first journal that they submitted it to, and then eventually it was published by this new coming, crazy journal in Chicago, which back then didn't have a lot of reputation, JAR. Yeah, and it worked out, right? Didn't it? So it really created a lot of debate. It motivated a whole line of the literature, and it also is still empirically descriptive today. So a really, really, really great piece of work, and also bold, right? Be bold. Cool. I love that. So if you take this as a motivation to follow your own ideas and to present them, be my guest. Perfect. So this ends this element, and now our next element will also be exciting because we're looking at one of my favorite all-time papers, Grossman and Stieglitz 1980. So stay touched, stay tuned, and see you there. Bye. Thanks.